Our company, or PAC, strives to provide customers with quality but economical goods. We will be analyzing their fiscal years 5 and 6. I am the CEO of the company. My name is Jandre Garcia. I will be explaining to you our objectives and targets.
As you can see, PAC reveals lower than target figures for year 5 and 6. ROA for year 5 is negative due to the closure of production lines and the loss of revenue. Yet in year 6, a heavy investment into new production lines increased revenue but also increased the number of assets, making ROA lower than our target. ROE shows the same weakness in net income. Net income is negative because of the low revenue and high expenses for year 5. Although year 6 is promising, the increase in production increased inventory and has increased production and operating costs for the company. Market share was lost during year 5 due to insufficient inventory, and after a heavy investment into advertising, it has also increased by a slight figure. Stock price is lower than our target because net income was negative for year 5. And after a counteractive strategy to increase price by repurchasing stock and paying dividends, it proved to be in vain. Unit production cost shows to be lower than our target also. Lowering costs for year 5 is not a plus, but a consequence of less units to be produced, therefore less material and costs incurred. Total net income is reflecting the factors above. Year 5 was devastating, with the closure of 2 lines, which were done in an effort to decrease costs. But in year 6, the investment increased revenue and we see a positive turn for total net income.
Hello, my name is Jonathan Puglisi. I was the CAO for this company, and I'm going to be talking about actual versus planned numbers for operations management. Total research and development spending was higher than we planned due to our desire to become more competitive in the industry. This increase in research and development led to us introducing higher model numbers than we had planned. For total training expenses, we decided to reduce costs in an effort to stay competitive, which led to a decrease in total training expenses. Our beginning inventory was slightly lower than planned in both years due to a change in sales numbers. Due to the lower than anticipated sales, our storage expenses were higher than originally planned as well. In an effort to increase available units, we increased production, which resulted in higher outputs in years 5 and 6. Units shipped to sales office in year 5 was slightly lower than planned due to a lack of demand. An even lower demand created a large drop in units shipped in year 6. The same lack of demand also resulted in lower units shipped to customers in years 5 and 6. I'm now going to talk about actual versus planned numbers in financial management. The only difference in financial management was an increase in bonds issued or repurchased. We repurchased bonds in an effort to increase our stock price. The same desire led to us to increase dividends paid to stockholders.
My name is Yan Ding. I'm the Chief Marketing Officer. I'm going to go over the actual versus planned number for marketing. As the Chief Marketing Officer, I know the important role market share is playing. It has a significant relationship with net income. However, due to the miscalculation of our forecasting in the previous year, our market share dropped tremendously. So starting year 5, we decided to change our marketing strategy in order to regain market share, thus leading our company to a more profitable stage. In order to do that, first we tried to maintain our price the lowest amongst the industry comparing to our competitor. Secondly, in order to maintain our low production cost, we decided not to hire new salespeople. Regard of the salary and commission, our strategy is to uphold a decent salary, while in the meantime, we increase the commission accord whether it's peak season or off-peak season. And lastly, regarding the advertisement spending, as we mentioned before, market share play an essential factor of our net income due to the fact we increase our advertisement spending. And luckily, if you take a look at our sales number, our sales value went up over 40% than we forecast in the 2-year plan.
My name is Yesenia Rodriguez. I am the HR officer for this company, and I'm going to be explaining to you guys a comparative performance.
As you can see in these tables, for our return on assets for year 5, our company's ROA is negative 9.10%, which is the lowest percentage compared to other companies' ROA. For year 6, our ROA is 21.14%, which is in the 3rd place, slightly lower than a few other companies' ROA. Compared to our ROA from year 5 and our ROA in year 6, it increased over 30%. The reason why it increased was because we opened 2 lines. On return on equity, our year 5 ROE is negative 13.61%, which is the lowest compared to other companies' ROE. For year 6, our ROE is 3.42%, which it did increase. The reason why it increased was because we had more sales in net income. But it is still lower than other companies and industry average. Why? Because our net income was really low in year 5. For our market share, in year 5, it's 12.83%. And in year 6, our MS dropped slightly to 12.42%. To help increase our sales and ultimately our market share, we increase advertising in every area each quarter in hopes to push out more units for sale. For stock price, in year 5, our stock price was higher than the industry average at $1.12 compared to the industry average of $2.80. And in year 6, it was $1.19 compared to the industry average of $10.25. We tried on buying back some of our stocks to increase our stock price. For our unit production cost, it depends on the quality and feature of our company's product. Because we wanted to provide a higher quality product yet an affordable price, we decided not to open too many lines in order to obtain cheaper production cost. Our production cost has been maintained slightly higher than the industry average in year 5, with a UPC of $5.12 per unit compared to an industry average of $4.48. And in year 6, at $5.81 versus the industry average of $5.04. Our UPC from year 5 to year 6 increased significantly at a whopping 30%, and it was lower than Company 1 UPC in both year 5 and year 6. Total net income depends on sales revenue minus cost. We worked very hard to ensure that our expenses were lower than our revenues. Yet, due to numerous factors, our net income in year 5 wasn't very optimistic. Our net income for year 5 was negative by $1,375, which is the lowest compared to our competitors' net income, as well as the industry average of $2,197. After that, we realized that market share played a significant role for us to maintain competitive to the other companies. In year 5, we tried to increase our advertising budget in order to remain our market share so we can stay competitive in industry. As a result of our effort, our net income finally turns back to positive in year 6.
Stella Grigorian. I am controller of PAC company. I'm going to explain our company's income statement variance analysis.
As you see, in the income statement analysis, added taxes is negative 31%. The value added tax proved to me much lower than we had forecasted. We experienced negative 31% variance from our forecast. During this time, we were selling Model 4 and Group 3 was selling Model 5, which caused a decrease of our project sales forecast. Advertising expense is 134%. It plays an important role in helping to achieve brand recognition and increasing sales. Transportation expense was low with a negative variance of negative 37% due to lower sales in areas Medica 1, Medica 2, and NISTAC. Research and development expenses were lower than we had originally intended. We were generating a negative net income, therefore we were decided to cut down our expenditure for research and development. Administrative and general expenses 39%. Negative variance of 39% is due to the decrease in training costs. We decided to decrease our training in year 6 because of our negative income. A reduction in employees for year 6 also affected our total administrative and general expenses. Operating profit 64%. Our 64% unfavorable variance in operating profit can be accounted for largely by the fact that we sold considerably less units. Our sales were low and company 3 with product quality 2 and feature 3 dominated that area. Storage expense costs were 99% higher than we forecasted. We had anticipated greater amount of sales which caused us to rapidly lose market share. This left us with larger ending inventory which required the storage, therefore increased our storage expenses.
I'm Gayane Hovasarpian, CFO of the PAC company. I'm going to explain cash flow and balance sheet variance analysis of our company.
Cash flow summarizes the actual or anticipated incoming and outgoing of cash in a company over an accounting period. Cash flow activities are operating, investing, and financing. In year 6, we continue to produce Model 4 and 5 at a quality level of 3, which increased our production cost by 10%. That's why our actual production cost is much higher than the been forecasted. The taxes paid of negative 58% depends on the result of the sales amount. The actual sales amount is lower than forecasted, and that's why the taxes we paid is lower. With no additional investment and cash on hand at the beginning of each quarter to finance, the PAC decided to repurchase an additional 500 outstanding bonds and 650 common stocks. Balance sheet. The balance sheet of PAC company states its financial position at the end of operating period of 12-month fiscal year. The unfavorable variance of negative 57% for cash balance was due to the fall in sales compared to our forecast. Revenues were lower than anticipated, which affects the cash balance. The positive variance for inventory was because our sales had declined and we had large amount of ending inventory. For year 6 quarter 2, we had Model 4 available for sale and had to liquidate some of the Model 3 due to excess inventory on hand. The actual for total liabilities was $20,887 compared to the forecasted amount $3,846, which had a variance for 4%. In year 6, we issued bonds to increase our stock price. Shareholders' equity is the net worth of the company. It represents the stakeholders' claim to a business asset after all creditors and debts have been paid. Shareholder equity usually comes from two places. The first is cash paid in by investors when the company sold stock. The second is retained earnings, which are the accumulated profit of a business has held and not paid out to its shareholders as a dividend. Our company's common stock is negative 29% than we forecasted because our company sold less common stock in year 6 than we forecasted. Also, our company's accumulated earning is 47% higher than we forecasted because we didn't pay out any dividend to our shareholders in year 6.
At PAC, we will continue to strive to provide our customers with quality and economic goods, as well as we will strive to put the company back into financial stability.